Japanese stocks closed the week on a positive note. Investors in Japan were net buyers of foreign bonds and the stocks over the past week, while foreign investors stepped out of the Japanese markets, perhaps temporarily, as more patience could be needed for additional monetary stimulus from the Bank of Japan. Now, the dollar yen traded range-bound between 101.90 and 102.70 last week. Monday's GDP release in Japan should give a fresh direction to trading in the yen market. The second quarter GDP growth in Japan could be significantly revised on the downside, perhaps by more than half, from 1.9% to 0.7% on an annualised basis. Now, should the growth data meet the pessimistic market expectations or bring in further disappointment, the dollar yen could challenge last week's trading range top. On an hourly chart, the pair remains in a negative trend below 103.25, which is the major 38.2% retracement on July 21st to the August 2nd sell-off. Now, above this level, a short-term bullish reversal could encourage a further rise to the 105 level. On the other hand, a satisfactory read could support the yen against the US dollar, especially as the US yields remain at depressed levels. A renewed appetite in yen could be a major threat to the 100 support this time. The rush into UK stocks and UK bonds continue. Now, the gilt yields hit record lows and investors are massively moving into the gilts market, considering an almost guaranteed gain on capital, as the Bank of England pledged to buy £60 million worth of additional government bonds following the Brexit vote. There is also a good appetite in corporate bonds and FTSE stocks. The FTSE reached the 6,900 level as some investors who found the gilt yields unattractive considered moving some cash into the stock markets. The weaker pound has also been supportive of appetite in UK businesses by increasing UK companies' competitive advantage across the globe, and also by creating opportunities for interesting M&A deals. However, the FTSE is now trading in overbought territories, which could hint at a downside correction in the short run before a renewed attempt to the 7,000 level. The pound slipped below the 130 level against the US dollar and could extend losses should the market fail to gain back the 130 handle. UK inflation data is due next week, and inflation in the UK is expected to remain close to zero. Now, the flat inflation figures give room for a looser stance from the Bank of England, given that the central bank is still very far from its 2% inflation target and its 3% upper limit. Finally, Eurozone inflation figures and the European Central Bank's latest meeting minutes should give some fresh air to the euro market. The euro-dollar extended gains towards the 112 level over the past week, and the 112 level is presumed as an important resistance next week. Potential dovish comments from the ECB on the economic conditions following the Brexit vote could dent appetite for the euro. Now, the euro-dollar is trading around its 200-day moving average at 111.40. A pullback below the 11100 mark could gain further downside momentum. Above 111.35, the major 38.2% retracement on last week's rise, the pair could bite into the 112 offers. So there's your technical outlook on some of the most important economic data releases next week. Tune in next Friday for a look at the following week, but for now, have a lovely weekend and goodbye.